Happy New Year. Thank you for joining us for Outlook. As we begin 2018, this robust economic cycle enters its 9th year. It's the second longest on record, and as such, for Outlook, we've borrowed a baseball theme and adopted a yogiism for the title, namely, "It ain't over till it's over," reflective of our belief that this cycle and related bull market in stocks is going to continue into 2018. Now, this may come as a surprise to many given the news flow, which has been so negative, so divisive and contentious, whether you look at newspapers, magazines, Facebook, Twitter, what have you. Last year the news flow was quite negative, and yet against that backdrop, we had a great year for stocks. The S&P was up almost 22%. Perhaps more impressive was the fact that stocks, for the first time on record, didn't so much as have a negative month throughout the course of the year. Now, how do we reconcile the difference between Wall Street and Main Street? In our view, James Carville, in 1992, when he was a campaign strategist for Bill Clinton, said it very well. He said, "It's the economy, stupid," referring to the fact that the market does a good job of sorting through the noise for the substance, to try to find the substance as it relates to the health and direction of the economy and corporate earnings. And the fact is, the U.S. economy is on solid footing, and the market has reflected that. Perhaps the bigger economic news as of late is the fact that we're now enjoying a synchronized global expansion, whereby the U.S. is not going it alone. But if you look at the chart here, the 5 largest economies in the world, representing about 3/4 of global GDP, for the first time in 10 years, are all expanding at the same time. If you take a broader look at the OECD 35 member nations, for only the second time in 50 years, all 35 member nations are expanding economically. So what we have is a very robust, solid economic foundation for capital markets here and abroad as we enter 2018. Now, over the long term, all that matters when investing in equities are 2 things: how much a company earns and how much an investor is willing to pay for a dollar of earnings. And from an earnings standpoint, we think this is going to be a great year in 2018. If you take a look at the breakdown here of S&P earnings growth, we think we'll have earnings growth of 15% or greater. And as you can see on the chart at the right, by far the biggest component of earnings growth is going to come through lower tax rates. The $20 of earnings growth that we expect, $8 or $9 of that will come from lower taxes. And as an investor, this is also good news, because for every $1 million you have invested, if you capitalize another $8 or $9 in earnings, that will translate into an additional $60,000 in portfolio value. So the tax plan has significant benefits, and the earnings growth of 15% or greater historically would suggest a capital market return of between 10 and 20%. However, if you look at valuations, PE multiples here, that tells a very different story, much more subdued. Again, 9 years into a bull market, stocks are no longer cheap. They're not in the nosebleed section, as this chart would suggest. We're, however, far up from the floor of 9 times earnings that we saw at the beginning of the cycle, and trading at 19 times earnings. History would say that the capital market return would be very muted, somewhere between 0 and 5%. How do we reconcile the 2 mixed signals between robust outlook for earnings and very muted expectations relative to valuations? At the end of the year, we think the result will be somewhere in between, is that the strong earnings growth will not fully benefit investors because rates will go up enough to cause multiple compression, resulting in an S&P return between 7 and 10%, which in historic terms is a very average, nice year for stocks. At this juncture, the biggest risk to our thesis is the Fed, specifically that the Fed raises interest rates too far, too fast. We believe that Rudy Dornbush, an MIT economist, stated it very well when he said none of the post-war expansions died of natural causes. Rather, they were murdered by the Fed while trying to fight inflation. The good news is we don't believe the Fed has any motive for murder, because we think inflation is going to stay contained. Here you see CPI going back to the 50s. A couple of things to note. Number one, inflation hasn't been a problem for 35 years. We've indicated in red the Fed's target for inflation at 2%, and you'll notice over the past 20 years or so, inflation's stayed pretty much contained to that. That said, we do believe that the firm labor market's going to translate into higher wages, ultimately higher inflation this year, but not enough for the Fed to take dramatic action. That said, we think the Fed will raise rates 3, perhaps 4 times this year. Now remember, what the Fed controls is only short-term rates, only the Fed funds rate, which you see here in blue. Going back to the mid-'80s, we've marked 3 instances of murder, if you will, where the Fed very aggressively raised rates and choked off economic growth. The most recent being in 2004 to 2006, raising rates at 17 consecutive meetings. Of course, we know what happened. That brought the economy to a halt, burst the housing bubble, and brought on the Great Recession. As you see here on this chart, what the Fed is doing in raising rates is not fighting inflation at this juncture, but rather trying to normalize rates, trying to address the zero interest rates that we had between 2008 and 2015. And as you can see on the far right, what's happened so far in this tightening cycle has been very modest, and the green indicates our expectations for continued modest rate hikes. Again, not enough to choke off growth, but merely enough to start to normalize the rates. And what this means for bond investors is it'll be a headwind. We believe the yield on the 10-year will trend up from 2.5% to 3% and result in net returns to investors of a coupon minus sort of backdrop. With respect to equities, nothing's cheap, as we indicated before, this far into a cycle. That said, we do believe that international equities offer relative value when compared to U.S. stocks. If you look here at the chart indicating PE ratios for U.S. large cap stocks trading at 19 times earnings, small cap U.S. stocks even more expensive at 24 times earnings. Those are in direct contrast to major economies of the world that are trading between 13 and 16 times earnings. So international equities are cheap relative to U.S. stocks. Going back to a baseball metaphor, we would also add, from an earnings standpoint, international equities are in the earlier innings of an earnings recovery. If you look here at the right, you see the trajectory of earnings on the S&P in blue and ACWI ex-US for international equities in green. Notice S&P earnings have grown very steadily into record levels over the past 60 months. International earnings, however, have only started to rebound in the past 12 months. So we're in the earlier innings of an earnings recovery abroad. So international stocks are cheaper, and they offer more catalyst in terms of more runway for earnings growth than do U.S. stocks. In fact, we recently made a modest portfolio allocation move away from small cap and into international equities. Within international markets, our favorite areas right now are Europe, Japan, and emerging markets. So to wrap up, we believe the U.S. is on very firm economic footing, bolstered very significantly by a synchronized global economic expansion that will benefit capital markets here and around the globe. Rising inflation modestly here will cause interest rates to rise, but not enough to choke off growth, but enough to present a headwind for bonds. Equities, we expect a very average sort of 7 to 10% return, and relative value is resonant in international equities at this point in time. Thank you so much for your time and attention. Take care, and we look forward to seeing you in the spring.